Hi guys, Max here, and this is of course your daily market update for yesterday, the 28th of July, and it was a really strong day for stocks, in particular a little bit of old world industries, companies in the industrial, in the real estate sector, utilities, basic materials, stuff like that, but there was still green across the board. It was mostly a really strong day for risk on equities. The S&P 500 then rose by 1.2% and the Nasdaq rose by 0.9%, with the Dow Jones doing a little bit better at 1% of gains. In the rest of the world, it was just a little bit less positive. China suffered quite poorly and the UK didn't do brilliantly, but the Americas were strong, the rest of Europe was strong, and the rest of Asia was okay too. The FTSE 100 fell by 0.1%. The Stock 600 rose by 1%, and on the whole then, the MSCI World Index rose by 1.3%. Now, in the world of foreign currencies, the dollar didn't really change value too much. The euro fell very slightly and is sitting at $1.02. The pound rose very slightly and is back up to $1.22. And the yen rose by about 2% actually, rising to 134 yen per dollar. So a strong day for the yen. In the world of the bond market, in fixed income assets, we saw loads of movement into bond prices, causing prices to rise and yields to fall. The US 10-year Treasury yield fell by 11 basis points to 2.67%, one of the lowest points we've seen it in recent months. And then the German 10-year yield fell by 12 basis points and the British by 9 basis points. And then finally, for commodities, well, oil prices are sitting exactly or pretty much exactly where they were over the last couple of days. WTI crude oil is sitting at around about $97 a barrel. Brent crude oil is sitting at around about $100. And then gold prices actually rose by about 2% for the day, back up to $1,770 an ounce. Finally then, for the market update, what happened over in crypto? Well, we saw crypto act as a risk-on correlated asset, just moving in the same direction as the equity markets, with prices rising for the most part. Bitcoin up by about 4% to $24,000, one of the highest we've seen it at over recent weeks, basically since that whole lunar collapse a few months ago. Ethereum, the same story there, except up by 6% to $1,700, and most altcoins were up by something like 5 to 10% for the day as well. It's been quite a strong day and a week actually. It's been a really strong week for risk on assets. Now, what actually drove the rally for yesterday itself? Well, of course, the big news was surrounding the new US GDP data that we got out, which was actually really negative. But we also had a bunch of movement based on the Federal Reserve's decision to hike interest rates by only 75 basis points, which actually came out the day before yesterday. Of course, we covered this in detail yesterday, so if you missed that video, go check it out. But in short, that was quite a dovish move. It wasn't very hawkish at all. And Powell mentioned offhand how we are probably past the peak and how it's likely we're going to see lower interest rate hikes in the future. Cue a whole load of investor euphoria, people spouting that the bear market is over, that Federal Reserve tightening is over, and that inflation is over as well. But in reality, nothing really changed. The Ukrainian war between Ukraine and Russia is still going on, and the impact of that on commodity prices is still extremely present. Inflation is still sky high, sitting at 40-year highs in pretty much every country in the world. Consumer confidence is still crashing and at rock bottom levels. Labour force participation rate is also at rock bottom levels, with fewer people with jobs than pretty much at any point in recent history too, despite what the unemployment rate would say. Mortgage rates are rising, making it more and more difficult to buy a house, and as a result of that, the housing market is starting to get seriously squeezed, and then debt servicing is up as well on things like credit cards and car loans too. The only difference between today and 4 or 5 days ago is investor sentiment. Literally nothing else. This is just animal spirits at work. This is the deluded markets and the inefficient market that we have because of over a decade of gross monetary policy that is really damn poor. Now, the actual news that we got yesterday was pretty much the same story, the same sort of thing, deluded investors making silly decisions once again. Of course, we got GDP data out and it was negative for the second consecutive quarter in the United States, meaning, despite what the White House will tell you, yes, the United States is now in a recession. The figure was a negative 0.9% change in GDP annualized over 4 quarters. For the quarter itself, it was negative 0.2%. And that's on top of the first quarter change, which was negative 1.6%. Now, why did it fall? Well, a bunch of different reasons. Higher interest rates hurt business investment. Also, business inventories have continued to fall as people are getting rid of stock. And that's the same as the last quarter. And then also the strong dollar is making it difficult for companies which export an awful lot. Personal consumption actually rose by about 1%, which does seem to be the silver lining of this report. But personally, I don't think that's as good as it sounds. When rent is up by 15% year over year based on any real accurate data that we get from a site which has millions of data points like Zillow, but the Fed only recognizes 5% inflation in the rental market, the rest of that 10% of extra rent that you and I and everyone else in the world is paying, well, that's chalked down to economic growth as opposed to inflation. It's for this reason that understating inflation figures actually boosts GDP figures in real terms, and that's something that most people just tend to ignore, especially the pundits online. Real inflation, before the US actually started manipulating their data back in the 1980s and then again in 1990, well, we'd be sitting at CPI of over 15% right now. This GDP data is bad news for the economy, but that's good news for the inflation, as I'm sure you know, but that's a hard thing to price by investors. Now, investors obviously love this news. That's why asset prices rose for the day. Now, a lot of people are assuming that the Federal Reserve is going to pivot based on this news. Basically, they're going to say that the economy is so bad that the Fed has to stop their rate hikes and actually go in the opposite direction and start cutting interest rates earlier. And so stocks will do well. That's the idea. This paragraph here explains it quite well. Bad news is becoming good news. When the economy is slowing, inflation measures will likely fall. That will bring the end of the tightening cycle nearer, and markets will like that. The market is now actually pricing in a terminal rate of 3.25%. That's the point they think at which the Fed will stop rate hikes altogether and start to wind the clock back in and turn it all around. In my opinion, though, this is a very naive view to hold, and it doesn't really stand up to what Jerome Powell actually told us yesterday. He said, and I quote, "Allowing inflation to become entrenched would be a worse outcome than moving too aggressively. Price stability is what makes the whole economy work." And he also said that he wouldn't hesitate to implement a sharper rise if warranted by economic data. I think it's clear as day, in my opinion, that interest rate hikes will continue, and they'll continue to be rather major until inflation falls, and not until the economy starts to contract. We still don't have any evidence whatsoever that inflation is dropping substantially in the US, but the markets are just ignoring this and hoping that we'll get that inflation data soon. But this has been the exact same thing that they've been hoping for 18 months now, and every single month they come out wrong. Now, the only argument that I really agree with in this position, and that I can understand why people disagree with me on, is that they're betting against the Fed having a strong backbone, which is a fair bet to make. They've been incredibly weak over the last 2 years, but I do now think the narrative has changed, and I think the Fed has changed and their priority has changed too. Inflation is now the be-all and end-all, and the economy doesn't really matter to the Fed right now. Now, later today, it might already be out for you by the time you're watching this video, but we'll get US PCE data and personal income data, and then finally data surrounding consumer confidence in the United States. Now, I suspect all of this data will be bad for the economy, but it will all be ignored by investors anyway, and it will be taken in a bullish stride, and so asset prices will probably rise anyway. I also think it's a little bit prudent to have a quick mention of the White House's propaganda campaign and disinformation campaign surrounding the topic of a recession, because it's been a huge topic recently. And if you haven't seen my previous videos, the White House and the US government is trying to redefine a recession so that they can claim the United States isn't in one. Now, everyone and their mum knows that a recession is 2 consecutive quarters of negative GDP growth. The White House refuses to accept this, and they've gone on a war of definitions trying to change the language that we use, and sadly, they are winning. This right here is the definition of a recession according to a quick Google search 3 days ago. A period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. Now, this is the exact same search and what it gives you today, just 3 days later. In economics, a recession is a business cycle contraction when there is a general decline in economic activity. Recessions generally occur when there is a widespread drop in spending. Absolutely nothing to do with 2 consecutive quarters. This has been erased from Google in its entirety. Unfortunately, historically unbiased sources have actually been corrupted too, including Wikipedia, and this here is a changelog of the definition of a recession according to Wikipedia over the last day. This isn't even over the last 3 days. You see this red stuff here? That's what it used to say. While national definitions vary, 2 consecutive quarters of decline in a country's real GDP is commonly used as a practical definition of a recession. That's now been changed to there is no global consensus on the definition of a recession. That's changed over the course of just one day. Wikipedia has now banned anyone from commenting or changing this definition on their site. The page is now 100% locked. This is frankly absolutely ridiculous, and it's doublespeak, it's truththink, whatever dystopian words you can come up to describe the US government, well, they apply perfectly today. The government is changing definitions to fit their agenda. It's absolutely ridiculous, and we can't allow this to happen. Now, over in the UK, there's a little bit of a different story, but it's still in that same sort of vein. Basically, everyone over here is saying that we are in a recession, and here's a hint for you. Yes, they're right, we are in a recession. The second quarter data for the British economy is going to be out soon, and it's probably going to show us in a recession with 2 consecutive quarters of negative GDP growth. There is no government attempt to redefine the recession over here, though. The problem is, officials are using this negative data to push the idea that we shouldn't raise rates further and to just let inflation run supreme. Now, the argument that they're putting forward for this is that about half of our inflation in the UK has been from energy price shocks, and raising interest rates won't lower those energy prices. The problem with this argument, though, is that inflation was expected to get to 7 or 8% without the war in Ukraine anyway, back here but in February before the war actually started, and inflation is still mostly due to 0% rates and gross money printing, irresponsible government policy, and rate hikes are needed to fix that policy. Now, the Bank of England is expected to raise rates by about 50 basis points this month. I'd like to see them raise it by more, but I think that's unlikely. It's better than 25 basis points, though, which is what they've been doing over recent months. The Bank of England used to be ahead of the curve on this situation. They used to be really quite hawkish and quite strong as far as central banks go, but now they are completely behind the curve, and they've lost their nerve regarding tightening the economy. Now, to finish up for the day, we have a little bit of corporate news. We got earnings out from Amazon and Apple, and they were both pretty strong. Now, if we start with Amazon, it was really strong, and their shares are up by 13% in after-hours trading, which is an insane jump equivalent to over $150 billion in value created. Now, in terms of the actual data, well, their revenue was a beat of $121 billion versus $119 billion expected. Their earnings was negative 20 cents per share, but there was no real consensus regarding an estimate of their earnings. They were all over the place. In general, though, this does seem to be a slight miss. It's a little bit hard to judge, though. Amazon did, though, book a $3.9 billion loss on the shares of Rivian that it owns, the electric truck maker. So this isn't Amazon's core business that actually lost that money. Now, Amazon Web Servers beat revenue $19.7 billion versus $19.5 expected. That's a nice solid figure. And their advertising brought in $8.76 billion versus $8.65 billion expected, which is another strong result. They saw 7% growth in their revenue over the last quarter, which is very nice. And they put out another strong outlook for the next quarter, expecting revenue of $125 to $130 billion when analysts were expecting 126. They have, though, reduced their staff count by 99,000 people, and they have a hiring freeze present. Not an absolute freeze, but, they're slowing down the amount of jobs that they're creating. Amazon's sales on their website itself are suffering, but that has been expected. They saw negative 4% year-over-year growth, and then their ad revenue beat competitors and actually rose by 18%, which is really strong, especially at a time when Facebook and Google have been struggling a little bit. So their share price rose by 13% after hours because investors loved that strong report and they loved the strong guidance for the next quarter too. Now, Apple also put out their earnings, and it was good, but not quite as strong as Amazon's, so their share price is up by about 3% after hours. Now, their revenue was a beat of $83 billion versus $82.8 billion expected. Their earnings per share was a beat of $1.20 versus $1.16 expected. Now, Apple divvy up their different revenue sources by loads of different ways, so I'll save us some time and just look at the two biggest, most important ones, which are iPhone revenue, which came in at $40.67 billion versus $38.33 billion expected. That's a hugely strong result and pretty much drove the strong results that Apple saw in this entire report. And that's also 3% year-over-year growth. Now, in their second biggest sector, the services revenue, well, actually missed with $19.6 billion of revenue versus $19.7 billion expected. That's still 12% year-over-year growth, though. It's a very strong result, even if it did slightly miss expectations. Their gross margin is about 1% higher than it was expected to be, All in all, it was a really solid, a very good report, but nothing amazing. Unfortunately, they haven't decided to give any formal guidance for the next quarter, which is a little bit of a shame. They are seeing some slowing demand, which has been expected for tech products all over the economy as the recession kicks in, and inflation is starting to impact their costs, which is a slight concern for the future, but nothing outsized compared to what most other companies are facing right now. Finally, for the day, I thought I'd just mention very quickly that Nancy Pelosi, that wretched woman, is due to head over to Taiwan, but this is a little bit up in the air. China is really angry about this idea, about an American official and quite a high-ranked one heading over to a country which it considers to not be a country and thinks of it as sort of some separatist state. The US are obviously trying to push for this trip. That's why they've organized it and they want it to go to head. This is just one example though of escalating tensions between the two powers, and we should expect this stuff to continue on for years. The relationship is slowly deteriorating and that isn't going to stop anytime soon. There have been military threats made by both sides here and it really doesn't seem like it's going to go away overnight. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.